think it's important to introduce our guests. We have Marty Wallace with First Home Mortgage.
Yep.
Thanks for having me.
Yeah, of course, man. So First Home, there's a lot of great lenders that are in the market. First Home has been a great mortgage resource for us and our clients. And we thought it would be great to have him kind of join us, just talk kind of where interest rates have gone the first 45 days of this year, where you see them ending up. I think everybody's curious with that because they're so volatile right now. Doesn't seem to be stability at all on that front. So.
With where rates have gone, I guess since the beginning of 2023, everyone kind of knows what happened last year. We saw the sharpest increase in rates in the history of mortgage-backed rates and period in the early parts of last year. With that being said, they kind of trended upwards all year. We saw it kind of soften up towards the tail end of the year, and then a little bit softer into 2023. Until that really happened, they've remained relatively steady. We saw a little bit of a decline after the most recent Fed meeting, where instead of kicking it up their usual 75 basis points, they actually only kicked it up 25.
Which is what they lend.
That's the overnight lending rate. That's not
mortgages.
It's not a one-to-one mortgage rate.
Right.
It's just how much it costs for people to lend money or borrow money from the Fed.
From the government, right?
Yes. But
that indirectly impacts mortgage rates.
Yes. Okay. And the reason being is because with them not increasing the overall Fed rate as high as they have been, that shows that inflation is starting to come down a little bit. Some of the things, the quantitative easing that they've been talking about, it's starting to work a little bit.
Good.
So we saw a little bit of, a softening up, I would probably say last month. With that being said, rates have kind of starting to level out. We're starting to get a little bit of a footing as to where rates may remain throughout the remainder of the year.
Tell us more.
Let's get to it, man.
That's the golden goose.
Let's get to it. Right now, I would say, I haven't checked today, unfortunately, but right now, Freddie Mac has the 30-year national rate around 6.5, 6.6.
Okay.
And that's kind of where the market is right now. I don't necessarily have a crystal ball. If I did, I'd be a very, very wealthy man.
Yeah.
But nobody really does. There's a lot of opinions, there's a lot of ideas of where things can go, and there's a lot of different factors that can buy into and pay dividends as to where rates will actually go.
I mean, there's things that are unforeseen too, like socio-economically too. Like you consider like what's going on in Ukraine, like that can impact things, right? Like get into an escalated
or the train derailment debacle.
Yeah, I mean, so a lot of these factors can impact indirectly mortgage rates, right? In the market.
Correct.
Yeah.
Yep. Some of the major ones, like you just said, are major headlines, things that affect our economy directly. Like you said, those two major instances are definitely playing part into it.
So what if we know you don't have a crystal ball, but if you were to guess, are we staying stable? Are we increasing? Are we decreasing over the next 6 to 12 months?
If I had to guess, kind of based off of where the market has been over the past couple of years, and quite frankly, over the past, call it 10, 12 years after the 2008, when things started to kind of calm down in 2010 and thereafterwards, I would say optimistically we are leveling out.
Okay.
I don't anticipate rates to necessarily drop in the next 6 months on the early side, 18 months on the longer side.
Okay.
But I think that we'll kind of find our footing, just because in addition to interest rates, the low inventory is one of the main reasons why rates haven't dropped, simply because if you lower the rates, that's going to flood the market with all the pent-up buyers.
Yeah,
and what that's going to do is majorly increase the sales prices.
It'll be spring 22 2.0.
So interest rates are, in a way, keeping the housing market within like a price control.
Yeah. We feel that on both ends. I mean, as an agent and consumer, it still feels like there's not a lot of inventory, and the buyer pool that's out there is still super serious. Mm-hmm. So when a good property does come on the market and it's positioned properly, there's usually a few offers or a few buyers in line. You're getting more of those contingencies that we didn't see in 2021 and 2022, but they're still hot.
Yeah. I mean, I read in CNBC this week. There is 960,000 homes active on the market across the United States, which, just to put it in context, under normal market conditions, which we'll go back to 2019 pre-pandemic, at any given point in time in the United States, there's around 1.5 to 1.8 million homes for sale. So we're about half that. That doesn't get fixed overnight.
Right.
So, I mean, it feeds into where prices are going to go. And a lot of people were talking about, I'm going to wait for prices to drop. And I just can't put my finger on seeing that happen, even in spite of interest rate volatility. Just looking at census data, you look over the next, you just look at generations. So the millennial generation is the largest generation there is. Less than 50% own homes.
Ooh.
These are 26 to 41-year-olds, right? The generation behind that are 18 to 25-year-olds.
Wait, we're
Gen
all
Z.
millennials?
Huh? I'm actually Gen X. I'm 79, babe.
Oh, wow.
Okay, don't include me in that millennial junk. Okay.
Are you? Yeah, you're
93.
Yeah. Gen Z is 18 to 25-year-olds, so they're starting to get into that phase of life,
right,
where they are establishing some income. They're grounded in their careers, maybe the older part of that generation.
Right.
Less than 2%, according to the census data, own homes. So the largest demographic in the United States, the millennials, less than half own homes. And Gen Z, the generation behind that, 2% own homes. And when polled, Bankrate did a poll with a combination of the two generations. 65% of them value home ownership as the pinnacle of financial success.
Wow.
So less than 50% of these two generations, way less for Gen Z, own homes, yet they value it as the highest level pinnacle of success, financial success. And 75% of them want to buy in the next 5 years. There's going to continue to be pressure on buying houses from these two generations, if not from other people. And here's the other thing too. 70% of current homeowners have interest rates 4% or less. Ooh. So the incentive to put your house on the market when interest rates are 6 or 7 and go find another house at a higher interest rate is less. So I don't know where the inventory is coming from. And there is definitely going to be some pent-up demand from these two generations that want to own homes. I just don't know. Again, supply and demand is what drives price when that drops.
I'm having that conversation with sellers all the time right now that they're looking at their interest rate. They would be willing to sell and possibly even move up, but they're looking at a 3.5% interest rate versus a 6. They're just going to wait it out. Now, as far as your side goes, what are you seeing the difference between the 2021 buyer and the 2023 buyer that you're taking an application from? What's their motivation? What's the difference?
I would say the biggest difference is your buyers, kind of like Nick just mentioned. I mean, your millennials, what was that exact age? 25 to 40?
Yeah, they're about 25 to 41, 42.
41. So, I mean, those are primarily the applications I'm seeing right now.
Yeah.
And the reason being is because the houses being bought this year, more so than the previous 2 years, are completely out of necessity. People that are renting, people that need to move into a bigger house, people that have outgrown their homes, people who need to move for job relocations, whatever it is. In 2020, you saw a lot of people buying houses simply because they could. They could afford it. Very low interest rates allows you to buy more house. So people kind of left their homes and moved into bigger houses where their payment either stayed the same or was slightly higher.
So that ties right back into the previous videos we've done, and what Nick and I continue to preach is that we're now back to a normal necessity-based selling cycle versus an opportunity-based issue.
I would 100% agree with that.